There's a specific moment in every trader's journey, a silent crossroads, where logic and belief collide. It doesn't happen on your first trade. It doesn't happen when you're a beginner experimenting with random entries. It happens later, when you finally start to understand the markets, when you think you've figured it out. You spot the setup. You execute with confidence. Everything aligns: structure, trend, confluence, momentum. You're not guessing. You're certain. And because you're certain, you place the trade differently. You size up. You remove hesitation. And somewhere, without even noticing, you begin to believe, this trade shouldn't lose. So you place your stop loss, but deep down, you don't expect to need it. Not this time. Not on this trade. Then, price moves against you. At first, it's small, nothing unusual. A pullback, a wick, a temporary reversal. No panic. You've seen this before. But then it keeps moving, slowly, relentlessly. And now your stop loss, the one tool designed to protect you, doesn't feel like risk management. It feels like an attack, an insult, a threat to your conviction. So you do what millions of traders have done before you. You justify it. It's just market manipulation. Liquidity grab. It'll reverse. It's testing a level. This is normal. News messed it up, but the idea is still valid. And then, the moment that decides everything. You move the stop loss. Just a little. Just enough to give the trade space. But it doesn't help. Price keeps going. Your conviction turns into hope. Hope turns into anxiety. Anxiety turns into denial. And finally, when the pain becomes unbearable, you close the trade manually. Not because it was part of the plan, but because you couldn't take the emotional pressure anymore. And what happens next? Price reverses. Perfectly, cleanly, mockingly. And the mind whispers the most dangerous sentence in trading. If I didn't use a stop loss, I would have won. That is the birth of the stop loss paradox, where the very tool designed to save your account becomes the first thing you stop respecting, where belief becomes blindness, where conviction becomes ego, where strategy becomes emotional negotiation. And from that moment forward, you no longer manage risk. Risk manages you. The paradox is simple. A stop loss is not a line on a chart. It is a decision, a pre-accepted truth. If the market goes here, my idea is invalid. But when belief overrides reality, you stop accepting that truth. You start believing that losses are optional, that market structure will obey your bias, that you can outweight the market, and that belief, not the trade, is what destroys consistency. Because the market isn't punishing you, it's revealing you, your discipline, your emotional tolerance, your relationship with uncertainty, your attachment to being right. This audio is not about stop losses as a technical tool. It's about the psychology that determines whether you respect them or rewrite them. By the end of this session, you will understand why traders ignore stop losses even when they know better, how conviction turns into denial without warning, why your brain treats losses as identity threats, how to rewire your mindset to obey your rules under pressure, and how professionals use stop losses as protection, not negotiation. Because the truth is simple. A trader without a stop loss isn't confident. They're exposed. This is where belief ends and professionalism begins. Most traders assume ignoring a stop loss is a technical error. It isn't. It's emotional. It's subconscious. It's deeply human. To understand why traders override risk management, we must look at what's actually happening inside the brain, not on the chart. Because the stop-loss paradox doesn't begin when price approaches the stop. It begins the moment you enter the trade. Humans are wired to seek patterns and predict outcomes. Trading is the opposite, a system of uncertainty, randomness, and incomplete information. So the brain does what it always does when faced with uncertainty. It creates a story. This looks like a breakout. The trend is clear. This is the same pattern as last week. The moment you believe the story, the trade stops being a possibility and becomes a personal expectation. Your mind shifts from "this trade might win" to "this trade should win." And the word "should" is where emotional attachment begins. A stop loss is logical. A loss is expected. Risk is part of the game. But psychologically, the brain doesn't interpret a loss as a neutral mathematical event. It interprets it as rejection, failure, threat, evidence of incompetence. Neurologically, loss triggers the same areas associated with physical pain, which is why removing a stop loss feels like relief, even if it leads to bigger damage. The brain chooses emotional comfort over logical protection. Once you believe you're right, your ego becomes invested. So when price moves against you, it's not just the idea being challenged, it's your competence. That's why traders say, "The market is wrong. It's manipulation. This shouldn't be happening." The ego prefers blame over accountability. Closing at a stop loss feels like admitting the market was right, and you were not. So instead of accepting a controlled loss, the ego attempts to restore the narrative. And the quickest way to do that? Move the stop loss just a little bit further. Hope is the most dangerous emotion in trading because it feels optimistic, not destructive. Hope whispers, "It will come back. Just give it time. You've seen this before. Be patient." Hope masquerades as confidence. But true confidence is based on rules, not hope of escape. When hope enters, discipline exits. The brain is addicted to reward. Winning trades create dopamine spikes, and your mind begins associating trading with emotional payoff, not execution. So when a trade moves toward your stop loss, dopamine drops, and the brain fights desperately to avoid the emotional crash. Moving a stop loss becomes a coping mechanism, not a strategy. Many traders secretly believe, "If this trade wins, it proves I'm a good trader." That belief attaches identity to outcome. So the stop loss becomes symbolic not of risk, but of judgment. A stopped-out trade feels like failure. Holding longer feels like fighting for validation. Even if the account balance is bleeding, the core truth of this section, ignoring or changing a stop loss, has nothing to do with the chart and everything to do with fear of being wrong, need for validation, emotional attachment to belief, identity tied to performance, avoidance of short-term pain. A stop loss is not just a risk tool. It is a boundary between trading with emotional dependency and trading with professional detachment. And until that boundary is respected, consistency will remain out of reach. Ignoring a stop loss doesn't happen instantly. It happens through a sequence, a psychological progression, a slow erosion of logic until emotion becomes the decision maker. There are 6 emotional traps that lead traders into the stop-loss paradox. If you've melted a stop-loss before, you'll recognize every one of them. Trap number 1, the "it's just noise" rationalization. At first, when price moves against you, it feels harmless. You convince yourself, "This is normal volatility. It's just the spread. It's testing liquidity." And sometimes, you're right. But here's the trap. The brain now learns that ignoring early warning signs feels safe. And every time ignoring the danger works, the ego grows stronger. A boundary has already been crossed, quietly. Trap number 2. Confirmation bias turns into storytelling. Once conflict begins between your belief and the chart, the mind starts hunting for evidence to defend the belief. You zoom out. You zoom in. You change time frames. You draw levels you never cared about before. Suddenly, everything looks like proof. A wick is rejection. A red candle is just a retracement. A lower low is a manipulation spike. The market didn't change your perception, did? You're not analyzing anymore. You're defending. Trap number 3, the sunk cost fallacy. The longer you hold, the harder it becomes to exit, not emotionally, but psychologically. Your brain says, I've waited this long. I've survived worse. It's too late to close now. The trade becomes a time investment, not a risk management decision. The entry price becomes sacred. You treat neutrality as loss. You treat waiting as progress. But the market doesn't care how long you've held the trade. There is no loyalty, no negotiation, no reward for suffering. Trap number 4, the identity shift, from trader to defender. At this stage, something subtle but dangerous happens. You stop trading your system. You start protecting your belief. Risk management disappears. Objectivity disappears. Neutrality disappears. Your stop loss, once a logical tool, now feels like betrayal. Cutting the trade isn't just loss, it feels like giving up. And the moment a trader fights the market instead of following it, the trader has already lost. Trap number 5, emotional numbness kicks in. There's a moment where panic turns into numbness. You no longer feel fear. You no longer feel urgency. You detach, not with discipline, but with emotional exhaustion. You think, whatever happens, happens. If it blows, it blows. I'll reset later. This isn't acceptance, it's surrender. And surrender disguised as patience destroys more accounts than bad strategy ever will. Trap number 6, the fake victory that reinforces bad behavior. Sometimes, by sheer coincidence, price reverses. It comes back. It respects your bias. It stops bleeding and starts printing profit. And when that happens, the worst psychological reinforcement occurs. You conclude, moving the stop worked. You didn't just win the trade. You strengthened the belief that discipline is optional, that rules can be negotiated, that conviction is more reliable than risk management. One accidental win rewires your thinking more aggressively than 10 losses, because now breaking the rules feels justified. The result? The trader becomes trapped in a loop. Confidence leads to belief. Belief leads to attachment. Attachment leads to denial. Denial leads to rule breaking. Rule breaking occasionally works. Occasional success reinforces toxic habits. This loop continues until one of 2 outcomes occurs. A catastrophic loss forces a painful identity break, or a psychological awakening restructures discipline. The stop-loss paradox isn't about the chart. It's about the identity behind the decision. Because the truth is simple. A stop-loss protects your account, but respecting it protects your future. Conviction is one of the most powerful psychological assets a trader can develop, but only when it's controlled. There's a thin line between confidence and ego, between belief in an edge and refusal to accept reality. And every trader, at some point, crosses that line. Not because they choose to, but because they don't recognize when belief stops serving them and starts protecting their identity. Confidence, I trust my system, versus ego, my system can't be wrong. Confidence is grounded in structure, data, and probability. Ego is grounded in personal narrative, I know better. Confidence expects uncertainty. Ego demands correctness. Confidence protects capital. Ego protects pride. This is the turning point, when the stop-loss becomes an insult rather than a safeguard. How ego hijacks the trader's mind. The moment the trade goes against you, the ego responds. not with curiosity, but with defensiveness. Instead of asking, "What changed in the market? Is the setup invalid now? Did I misread the structure?" You think, "This shouldn't be happening. The market is wrong. It will reverse. It has to." At that point, you are no longer trading price. You're trading your belief about price. Ego's favorite lie: "It's not over until I say it's over." This is where the most damage happens. You widen the stop, then widen it again, then delete it. Not because strategy changed, but because the mind cannot tolerate being wrong. The ego reframes the loss as temporary. It's just a correction. Big money is hunting stops. Smart money is shaking the weak hands. These phrases feel intelligent, but they are emotional armor, nothing more. The dangerous comfort of being right eventually. One of the most toxic reinforcements in trading is being right late. When the market eventually returns to your original idea, the ego says, "See, I knew it." But here's the truth. It didn't return because you were right. It returned because markets move in cycles. You didn't win because you had skill. You survived because you were lucky. And survival, mistaken for skill, is the birthplace of blown accounts. Markets don't reward opinions. They reward risk control. You can have the right bias, the right pattern, the right analysis, the right direction, and still lose if your risk is unmanaged. Professional traders don't ask, "Was I correct?" They ask, "Did I execute according to rules?" Because the long-term game isn't about proving you're right. It's about protecting capital long enough for your edge to play out. The identity shift, from predictor to risk manager. When ego trades, the goal is to win the trade. When discipline trades, the goal is to protect the account. When ego wins, the trader feels powerful. When discipline wins, the trader becomes consistent. At some point, the trader must realize being right once means nothing. Surviving long enough to let math work means everything. The core lesson of this section. Conviction is not dangerous. Ego disguised as conviction is. A stop loss isn't there to prove you wrong. It's there to prevent one wrong decision from becoming a catastrophic one. The market doesn't punish you for losing. It punishes you for refusing to accept loss. And until you separate your identity from your outcomes, risk will always exceed reason. At this stage, you understand why stop losses are ignored. Ego, emotion, hope, and identity attachment. Now we shift from awareness to transformation. Because the truth is, you cannot stop emotional behavior with logic alone. You need a system that operates even when emotion is firing at full intensity. Professional traders do not rely on willpower. They rely on automation, constraints, habits, and identity alignment. This section is not motivational, it's mechanical. A blueprint to rewire how your brain responds when price hits discomfort. Step 1. Separate you from the trade. When a trade is open, your brain treats it as part of you. That's why a losing trade feels personal. To break this pattern, introduce a new internal language. Not, "My trade is losing," but "This position is doing something different than expected." Not, "I was wrong," but "The setup invalidated." Not, "I failed," but "The model produced a negative outcome," expected in probability systems. It sounds subtle, but linguistics alters emotional attachment. The language of neutrality prevents identity fusion. Step 2. Pre-commitment beats emotion. If you wait until price approaches your stop to decide, you've already lost. Decision must be pre-committed, not evaluated. This means stop is placed before entry, never adjusted emotionally, never removed, never negotiated. A pre-committed stop creates a psychological boundary. Once the trade is live, execution is over. Observation begins. You don't manage hope, you manage rules. Step 3. Make risk visually real. Numbers feel abstract. The brain ignores abstraction. So convert risk into emotional relevance. Examples. Label each position size in dollar loss, not lot size. Display the stop-loss amount visibly on screen. Place a reminder. If I remove this stop, I violate my plan. This is called cognitive anchoring, bringing subconscious avoidance into conscious awareness. It forces accountability. Step 4. Reframe the stop-loss as a strategic victory. Right now, your brain sees stop-losses as punishment. We reverse that. When a stop hits, say, out loud if possible, execution success. I protected capital and honored process. This rewires the dopamine loop. Instead of rewarding random wins, you reward precision, discipline, and adherence. And eventually, the brain prefers consistency over chaos. Step 5. Train with small size until discipline is automatic. If you cannot respect a stop-loss with small size, you won't respect it with size that matters. Small size removes identity threat. Once discipline is habitual, size can scale. This is why prop firms force low initial leverage, not because they underestimate traders, but because they understand human psychology better than traders think. Step 6. Replace hope with evidence. When doubt or temptation appears, ask one question. If I saw this same chart and I wasn't in the trade, would I still open it? If the answer is no, the emotional brain is in control. If the answer is uncertain, you lack a rule, not intuition. If the answer is yes, then the stop should remain untouched. This question removes bias and restores neutrality. Step 7. Build an identity that cannot break rules. The final shift is identity. A trader who tries to follow rules fails. A trader who is the person who follows rules does not require effort. Say it. I am a disciplined risk manager first, a trader second. When identity changes, behavior aligns. When behavior aligns, discipline becomes natural. When discipline becomes natural, the stop-loss becomes non-negotiable. The core truth of this section. Success is not about learning how to accept loss. It's about becoming the kind of trader for whom risk management is instinctive. Stop losses stop feeling like limitations and start feeling like freedom. Freedom from chaos. Freedom from overtrading. Freedom from emotional gambling. Freedom from identity attachment. Freedom from regret. A trader who respects their stop-loss doesn't avoid pain. They prevent unnecessary suffering. At some point, every trader realizes this. It's not the market blowing the account, it's the trader refusing to enforce risk. The turning point isn't a new strategy. It isn't a new indicator. It's this sentence. A small, controlled loss is not failure, it's protection. Once that becomes truth, not theory, your trading changes forever. Because then, a stop-loss is no longer a threat to confidence, a sign of failure, a punishment. It becomes a cost of doing business, a line between order and chaos, a tool that keeps you in the game long enough to... Here's the tactical reality. 1 disciplined stop-loss protects your capital. 10 disciplined stop-losses build resilience. 100 disciplined stop-losses build consistency. 1,000 disciplined stop-losses build wealth. Not because the stop-loss makes you profitable, but because it prevents catastrophic damage while your edge compounds. The formula that separates professionals from the 95%. Rule 1. Always define risk before entering. Rule 2. Never adjust your stop emotionally. Rule 3. Let math, not mood, determine longevity. Rule 4. Treat every loss as execution data, not identity feedback. Rule 5. Protect capital first. Profit follows discipline. Every professional trader, no matter their strategy, eventually realizes consistency is not created by winning. It is created by limiting the size and emotional weight of losing. You are not here to predict the market. You are here to survive it, master it, and grow through it. A stop loss does not stop opportunity. It preserves the account so you can take the next one. That's not weakness. That's elite execution.